Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to solve a question under IAS 10, Events After Reporting Period. In a previous video, I explained all the concepts that you need to know as far as the standard Events After Reporting Period is concerned. But here, based on your request, I'm going to solve a question so that you understand how to practicalize the principles that we have learned from the previous video. And so I don't want to waste much time. I just want to go straight to the point, read the question, and then solve it with you. Okay. The statutory audit of ABC Incorporation for the year ended 30th June 2023 was completed on August 30th, 2023. The financial statements were signed by the Managing Director on September 8, 2023 and approved by the shareholders on October 10, 2023. The next events have occurred. So these are the events. We are going to look at these events that have occurred and then we'll look at how to treat it. A. On 15th July 2023, a customer owing 900,000 Ghana cedis to ABC Incorporation filed for bankruptcy. The financial statements include an allowance for doubtful debt pertaining to this customer of 50,000 Ghana cedis. All right, so we'll come back and analyze all these things. B. ABC Incorporation's issued capital comprised 100,000 equity shares. The company announced the bonus issue of 25,000 shares on August 1st, 2023. C. Specialized equipment costing 545,000 Ghana cedis purchased on March 1st, 2023 was destroyed by fire on June 13th, 2023. On June 30th, 2023, ABC Incorporation has booked a receivable of 400,000 Ghana cedis from the insurance company pertaining to this claim. After the insurance company completed its investigation, it was discovered that the fire took place due to the negligence of the machine operator. As a result, the insurance liability was zero on this claim by ABC Incorporation. Requirement or required. How should ABC Incorporation account for these three post-statement of financial position events? All right, so this is a typical exam question, okay? We have been given three different scenarios, and then we are supposed to advise the company on how they should treat this. I told you that these standard questions usually come, and then you are in a position, an advisory position, as an exam candidate or as a financial analyst. You are supposed to advise the company. Now, there are key things that we need to analyze from the question before we can even give our advice on this. So let's begin looking at the question again, and I'm going to highlight on the key things that we need to know. In fact, one of the first things you need to ascertain is the date where the accounting year ends. Okay, so let's go back to the question. The statutory audit of ABC Incorporation for the year ended June 30th, 2023 was completed. Now, so the accounting year ends 30th June or June 30th, 2023. This is ABC Incorporation. June 30th, 2023. This is the date that represents the end of the accounting year for ABC Incorporation. Now, it is very key and vital for whatever decisions that we are going to make. Now, the statutory audit of ABC Incorporation for the year ended June 30th, 2023 was completed on August 3rd, 2023. So it means that the account has been prepared to the year ended June 30th, 2023, and the auditors have completed their work by the end of August, which is 2 months later. Now, let's continue. The financial statements were signed by the Managing Director on September 8th after the audit. So after the audit at the end of August, audit was completed. And on September 8th, it was signed. So these are days that you should pay attention to. So this is end of the accounting year. And then the audit was completed at the end of August. So by 30th August 2023, audit was complete. Then the financial statement was signed on 8 September 2023 by the MD, the managing director. So these are just key dates. They don't really mean, this is not the solution anyway. I'm just trying to draw your attention that as you read, you need to pay attention to key dates before you start even analyzing the situations or the scenarios that are given to you down there. And approved by the shareholders. So we are told that the financial statements were signed by the managing director on September 8th and approved by the shareholders on October 10th, 2023. So on 10th October, it was approved by shareholders. October 10th, 2023, shareholders approved it. So in other words, the financial statement has already gone through all the due processes ready for publication. All right. Then these events occurred. So let's look at the events that has occurred and then let's advise. First of all, the most important thing to determine is whether the event is an adjusting event or a non-adjusting event, like the way we explained from our previous video. So let's look at this. The first one says on July 15th, the dates in these scenarios are key and very important. On July 15th, where does July 15th fall from what we have done? July 15th is in between the end of the accounting year and when the audit was completed, somewhere here on the timeline. So July 15th. So please take note. Whatever we are going to talk about happened before the end of the audit, happened before all these things. It was just some 15 days after the end of the accounting year. And we know that during that period, financial statements were still being prepared. But anyway, let's look at this. On July 15, 2023, a customer owing 900,000 Ghana cedis to ABC Incorporation filed for bankruptcy. The financial statements include an allowance for doubtful debt pertaining to this customer of only 50,000 Ghana cedis. Now, someone owes us 900,000 Ghana cedi as a company, ABC Incorporation. Then we have already made an allowance for doubtful debt of 50,000, meaning that we expect that at least we get 850,000 difference. Then on 15th of July, 15 days after the end of the accounting year, while financial statements were still being prepared, there was the news that a customer or this customer has filed for bankruptcy. And once the customer has filed for bankruptcy, this whole 900,000 owed by the customer will become irrecoverable. This is an adjusting event. If you really paid attention to the video or the part 1 of this lesson, you would understand that when it's about receivables, especially looking at the date, this will be an adjusting event. And so the question is, we are going to take each of these statements one by one and look at how it should be treated. So we are beginning with the first one. How should this one be treated? So the first thing that we have agreed on right now is that this is an adjusting event and it is not too late to adjust it because it happened on 15 July. 15 days after the end of the accounting year, where we know that financial statements are still being prepared. And so what is going to happen is that we have already made an allowance of 50,000 for this customer for irrecoverable debt or provision for irrecoverable debt. So what we need to do now is that the customer now owes 900,000 and has filed for bankruptcy. So we increase the receivables, the provision or allowance for receivables of 50,000 that we have made, we increase it to 900,000 now because the customer actually owes 900,000 and has filed for bankruptcy. So it means that the whole of the 900,000 cannot be recovered. Therefore, instead of the allowance of 50,000 that we have made, we increase it to 900,000. So the advice is that the company ABC Incorporation should increase the allowance for receivable for that particular customer to the whole 900,000 that he owes, and then write off their debts from their financial statement and adjust it even before the auditors complete their audit. So this adjustment should be made by reducing your receivables. So in other words, you are going to increase your allowance for doubtful debt by 850,000, which is the difference. Okay, and then you reduce the receivables figure in the statement of financial position by the same 850,000. So that is what you need to do. So this is how you answer the first scenario, because we are told from the requirement, how should ABC Incorporation account for these post statement of financial position events? So the first one is that it's an adjusting event, and therefore you need to adjust by increasing your allowance for receivable with the difference 800, so that we write off the whole in the receivable of that particular customer, and then we are going to reduce the total inventories by that amount. So in other words, the whole of this 900,000 has been written off from the financial statement because the customer is bankrupt and cannot pay. So that is the first scenario. Okay, let's move on. Now let's look at the second scenario. ABC Incorporation issued capital comprise 100,000 equity shares. The company announced a bonus issue of 25,000 shares on August 1st. Now, this one is a non-adjusting event. According to IAS 33, earnings per share, there is a requirement in that standard, IAS 33, to disclose stock splits or rights issue in a financial statement, because they are very important in the preparation of the statement of financial position. So what we can say is that we are only being given information that the statement of financial position that we have prepared, the issue share comprise 100,000 equity shares. This is just an information that is being given. Nothing new has been done. But on August 1st, they announced a bonus issue. Now, this bonus issue was announced on August 1st. And August 1st is outside the period under consideration. So we are not going to adjust it on the previous year's financial statement, because we are issuing shares on 1st August 2023, which relates to the financial statement for the year ended 31st June or 30th June 2024. So it's not going to be adjusted. But according to the requirements of IAS 33, it needs to be disclosed. So at the end of the period, after the preparation of the financial statement, there should be a disclosure of the bonus issue in the current year's financial statement, that we are making a bonus issue of 25,000 and that equity shares comprise 100,000 shares. But we are not going to adjust anything on the current financial statement, because this is a non-adjusting event. We are only going to disclose according to the principles of IAS 33. So that is it with the second one. There is no big deal with that. Now let's look at the third one. Specialized equipment costing 545,000, purchased on March 1st, 2023, was destroyed by fire on June 13, 2023. So that one is within the financial statement period. The machine was destroyed by fire before the end of the year. The year ends 30th June, so please take note. On June 30th, 2023, ABC Incorporated has booked a receivable of 400,000 from the insurance company pertaining of this claim. After the insurance company completed its investigation, it was discovered that the fire took place due to the negligence of the machine operator. As a result, the insurance liability was zero on this claim by ABC Incorporated. Now, let me just take time to break this and make it simple for you. On 13th June, which is a date before the end of the accounting year. So 13th June happened somewhere here. So it's within the financial year under consideration. A machine that has been bought for 545,000 Ghana cedis. This is the cost of the machine. Was burnt. Fire destroyed it. That is what we are told. So this one, the machine that is costing 545,000 was destroyed by fire. And then, because this machine was insured, the company filed for a claim with the insurance company, trying to claim 400,000 Ghana cedis from the insurance company. So they filed for the claim. You know, when you file for claim with insurance companies will not just give you the money. They will investigate what caused the fire. So after the investigation, they realized that this fire was not within the scope of their agreement. This one was caused by the negligence of the machine operator. And in their agreement, when a fire occurs to burn the equipment, when it is not caused by natural factors or things beyond the control of the company, but caused by negligence, the insurance company will have a zero liability. And therefore, the insurance company is not going to pay any money to the ABC Incorporation. Now, ABC has lost the value of this asset. They were trying to claim 400,000, but they couldn't. The liability of the insurance company is now zero. This one is an adjusting event. First of all, it even happened within the accounting year. And also, they couldn't claim. So what is going to happen is that if they already have recognized the value of the machine as 545,000, they need to write it off from the books because it's no more there. Or if they had recognized any contingent asset relating to the claim from the insurance company, they should also cancel that from the books, write it off because it is zero. So they are going to reset the value of the machine to zero because they are not going to benefit from any claim. And that is an adjusting event. And so you need to explain this thing to the examiner if you're writing an exam. So what is going to happen is that if they had already written this off, and then they have recognized this as a receivable, a contingent one, then they need to quickly scrap it off and write it off to zero. And that is what you need to advise the company on because they did not benefit from any insurance claim. So this is how to look at a question with IAS 10. Now, there are other questions that we may look at going forward, but I am sure this has really broadened your understanding and then giving you a taste of how questions could be asked as far as IAS 10 is concerned. Okay. Remember to subscribe to this channel if it is your first time. Share this video and let others also have a benefit. And until we meet again for another video, it's bye for now. Thank you.